If your student loans are in default, 2026 could be the year the government starts taking your paycheck again. And most people won't realize it until the money is already gone. This is not a policy debate. It's a cash flow emergency. The scary part is how boring this looks at first. No dramatic repo truck, no bank calling your mom. You just open your pay stub and see less money. Or your tax refund disappears, or your credit score drops right when you need to move apartments, finance a car, or pass an employer background check. And if you're already stretched by rent, groceries, insurance, and a car payment, that missing money doesn't feel like an inconvenience. It feels like a chokehold. People love to turn student loans into a culture war. Forgiveness, politics, personal responsibility. Fine, but none of that matters when your checking account is about to get body slammed by collections. What matters is simple. What happens to your paycheck, your tax refund, your credit, and what you can still do before default gets expensive. So let's get brutally clear on the problem. Federal student loan collections restarting means borrowers in default can face wage garnishment, Treasury offset, and fresh credit damage. Wage garnishment means money can be taken directly from your paycheck. Treasury offset means the government can seize federal payments that would have gone to you, including tax refunds. Same debt, new pain. And honestly, the real culprit isn't just your spending, it's the system. Tuition exploded for decades. Wages didn't keep up. The Federal Reserve Bank of New York has repeatedly shown student debt balances in the trillions. The Bureau of Labor Statistics has tracked housing, food, and insurance costs climbing, while a lot of younger workers feel like they're sprinting on a treadmill. You were told education was the safe bet. Then life showed up with 7% rent hikes, $300 grocery runs, and entry-level salaries that still act like it's 2014. I've seen this play out in real life. A cousin of mine thought default was just a scary word on a letter. Then tax season came, and the refund he was counting on to catch up on rent was gone. Not delayed, gone. That's when a paperwork problem became a survival problem. And I used to underestimate this too. Years ago, I thought collections mainly meant annoying calls and ugly letters. I was wrong. The real damage is cash flow timing. If you lose $200, $300, $500 a month from an already tight budget, the dominoes start falling fast. Late rent, credit card float, overdrafts, more interest, more stress. That's why this topic matters. Not because it's dramatic, but because it's mechanical. And here's where the math gets uncomfortable. A borrower already living paycheck to paycheck does not need a huge garnishment to spiral. They need one badly timed hit. The Consumer Financial Protection Bureau has warned for years that cash flow volatility, not just low income by itself, drives financial distress. Translation? Even a decent salary can crack if the timing is wrong. So ask yourself, if your paycheck dropped next month, even by a few $100s, what bill would you miss first? Rent? Car insurance? Groceries? That question matters because default creates a poor way versus rich way split. The poor way is reactive. Ignore letters. Hope it goes away. Keep all your money in one checking account. Wait until the wage garnishment notice lands. Then panic. The rich way, or at least the financially literate way, is defensive and boring. You identify the risk early, protect cash flow, document everything, and use the federal repayment system before collections use you. Think of default like quicksand. The more you pretend it's not there, the deeper you sink. Think of inflation like a bucket with a hole in it. Your paycheck is already leaking. Garnishment just kicks the bucket over. That's why 2026 is such a dangerous year for defaulted borrowers. Budgets were already thin. This is the year the squeeze becomes visible. Mini reality check. Student loan default is not the same thing as delinquency. Delinquency means you're behind. Default usually means you've gone long enough without payment that the consequences get much more severe. For many federal loans, that can trigger collections tools private lenders don't have in the same way. That distinction is everything. Because once default machinery is moving, every month you wait can reduce your options. Stick with me, because the next number is going to make you angry. Under federal administrative wage garnishment rules, the government can take up to 15% of your disposable pay for defaulted federal student loans, subject to limits. That's not your full salary, but don't relax. For someone bringing home $3,000 a month after required deductions, that could mean hundreds gone before you even touch the money. Not spent badly, taken. And credit? That gets hit too. Payment history is the heavyweight champion of your FICO score. A damaged score can mean higher auto loan rates, worse credit card offers, harder apartment approvals, and more expensive insurance in many states. So this isn't one penalty, it's a system of penalties stacked on top of each other. Why do people keep treating default like a future problem when it can infect 5 parts of your financial life at once? Now, let me give you the thesis of this whole video in one sentence. In 2026, the biggest student loan danger is not the balance itself. It's the sudden cash flow shock of collections hitting borrowers who are already living on thin margins. Once you understand that, the solution changes. You stop obsessing over the total balance for a minute and start protecting your monthly survival. That shift matters because a lot of internet advice is useless here. People say, just pay it off faster. With what money? People say, just save more. In what universe? With what rent? People say, skip coffee. Yeah, because a latte is obviously the reason someone is getting hit with collections after years of tuition inflation. Stop taking advice from people who have never looked at a pay stub under pressure. What actually works is a 3-part defense. Not sexy, not viral, effective. Step 1. Find out your exact loan status this week. Not next month, not when your refund vanishes. This week. Log into studentaid.gov and identify whether your loans are federal, whether they are delinquent or in default, and who currently services them. If you see default, do not guess. Screenshot everything. Download your records. Write down dates, balances, servicer names, and any collection notices. Why is this step so important? Because confusion is expensive. I've watched people call the wrong servicer, sit on hold for an hour, then assume they handled it. They didn't. If your file is with a collections agency or a default resolution group process, the path is different than a normal repayment restart. You need facts before feelings. And if you have private student loans, that's a different lane entirely, with different legal tools and timelines. Know which battlefield you're standing on. Step 2. Use the federal off-ramp that restores control fastest. Loan rehabilitation or consolidation into an income-driven repayment path, depending on your situation. Rehabilitation is often designed to get a defaulted federal loan back into good standing after a series of agreed payments. Consolidation can sometimes move you into a new direct consolidation loan and then into an income-driven repayment plan faster. The right move depends on your timeline, your paperwork, and whether wage garnishment is already in motion. This is where most people freeze because the terms sound bureaucratic. So let me translate. Rehabilitation is like cleaning up your record over time. Consolidation is like replacing the busted container so you can start using a better payment system. Neither erases reality. Both can stop you from getting squeezed harder if you act early enough. Read the official federal guidance. Ask direct questions. Get names. Get confirmation numbers. But there's one thing even a lot of financially responsible people miss. The goal is not just to fix the loan. The goal is to defend your entire cash flow system before one deduction triggers 3 new debts. I changed how I think about debt after seeing this happen. A friend got hit on one side by collections and on the other side by credit card APR above 24%. The student loan problem didn't stay a student loan problem. It became credit card debt, overdraft fees, late utility notices, and a trashed emergency fund all at once. So step 3 is where you stop the bleed. Build a cash flow defense plan before the first forced deduction lands. Open a separate high-yield savings account, or HYSA, at a real institution like Allied Bank, SoFi, Marcus by Goldman Sachs, or Capital One. Not for investing, not for vacation, for shock absorption. Even $500 to $1,000 in a buffer can keep a garnishment from turning into payday loan chaos. Then go line by line through your monthly bills. Cancel subscription leaks, call your auto insurer, renegotiate your phone plan, move due dates if needed. If your employer offers split direct deposit, route a small, fixed amount into that HYSA automatically. Why? Because automation beats motivation when you're stressed. Rich people automate wealth. Broke systems automate penalties. You need your own autopilot. And yes, if you have high-interest credit card debt, protect yourself from using it as a life raft. Quicksand on top of quicksand is still quicksand. If collections restart and your answer is, I'll just float groceries on the card, your APR can turn a temporary cash squeeze into a multi-year mess. The average credit card APR has hovered above 20% in recent years, according to Federal Reserve data. That is not breathing room. That is a trap with branding. One more thing, check your withholding and tax expectations. If you're counting on a large refund every spring, understand that Treasury offset risk can turn that refund into a fantasy. I'm not telling you to play games with taxes. I'm telling you to stop mentally spending money that may never arrive. If your budget only works because of a refund, your budget is fragile. This is the part no one likes hearing. There may be no heroic cinematic fix, no rich uncle bailout, no magic loophole. Just paperwork, phone calls, follow through, and a few smart moves made early. But that's good news too, because boring systems are learnable. And I want to say this clearly if you're embarrassed. Default does not mean you're stupid. It does not mean you're lazy.